Welcome everyone. There are four triggers that can lead to a secular bull run in an entire sector: structural reforms, technological innovation, demographic shifts, and global capital flows. Today, let us analyze six sectors to see which of them can lead the next bull run in India. Stay tuned because we'll also discuss specific stocks that stand to benefit the most in each sector. Let's begin with the ever-evolving technology sector, and there are three key structural drivers here. The first and obvious is artificial intelligence. Big data analytics, AI, blockchain, and IoT are becoming mainstream. Indian firms are investing heavily in R&D to stay ahead. Persistent Systems is a particularly interesting stock here for their healthcare applications. Active investors should read up on their products in computational drugs and OmniKG. Second is the global digital shift or the demographic shift. Businesses worldwide have accelerated their digital transformation, increasing demand for cloud services, cybersecurity, cyber infrastructure, and AI-driven solutions. Esconet Technologies is placed in the sweet spot here, where high-end computing meets data storage and cybersecurity. Localization and data sovereignty is also an emerging trend where countries like the US, Europe, and Japan are pushing for data localization laws, boosting Indian IT firms' domestic opportunities. Our government has also been clear about its intentions with data centers. We want to keep our data in our country. AnantRaj and its ambitious plans to capitalize on its land bank to build data centers make it my primary candidate for success. Before we go investing in IT though, we must be aware of their SWOT. Our key strength lies in our large client base and established global reputation, while the high dependence on US and Europe are a glaring weakness. Any slowdown in the US would disproportionately impact Indian IT. However, the steep growth in AI and cybersecurity would ensure that established players in this segment can weather a recession with ease. Next, let's decode why banking and financial services could take the lead. There are multiple structural drivers for growth here. First is the obvious growth in India. As India's GDP growth accelerates, credit demand in retail, especially small ticket home loans, will increase substantially. Home First Finance is my pick of the lot. They're modernizing the lending process to small ticket consumers. This is a massive opportunity, and that is reflected in the almost 70% ownership by foreign and domestic institutions like Goldman Sachs, Fidelity, and Vanguard. That, combined with historically strong balance sheets, have put both public and private banks in the perfect position to capitalize. Indian PSUs, especially SBI, would benefit the most since most of the government-linked tenders are financed through PSUs. Financial inclusion with initiatives like the Jan Dhan Yojana, digital wallets, and the United Payments Interface or the UPI have expanded banking to the rural sector as well. My pick here would be J&K Bank, who for the first time in history can see investments and credit demand come from outside the state. The digital transformation and expanding customer base are key strengths for this sector, while the end of the current credit cycle and an impending slowdown are key concerns. New insurance innovations like Even are also disrupting established businesses like insurance, which can be both an opportunity and a threat. Next is renewable energy and EVs, where we have four key drivers. First, and perhaps most importantly, is the declining costs. Solar and wind technologies are becoming cheaper, making large-scale projects economically viable. This is a revolutionary change that is for the first time in history allowing renewable energy to practically compete with fossil fuels. Inox India, SJVN, and Adani Green are the companies that stand to gain the most out of this push for green energy. Inox India is a particularly interesting stock since it has a moat around green hydrogen transport that makes it indispensable to the entire industry. Second is the policy push where tax incentives, renewable energy tenders, and subsidy schemes favor private sector investments into renewable energy. The target to reach 500 gigawatt of non-fossil fuel capacity by 2030 under India's Nationally Determined Contributors or NDCs will catalyze growth. Firms like Tata Power will play a key role in reaching this ambitious target, especially through its rooftop solar program that this company completely dominates. To facilitate the push into renewables, climate finance from organizations like the World Bank, Asian Development Bank, and Green Bonds are fueling growth across borders, which is again a first of its kind effort. It is as if humanity is coming together to ensure we have a better way to power our future. That reflects in corporate commitment as well. Major Indian corporates including Adani, Ambani, Tata and Jindal are investing heavily in renewable energy projects. The biggest strength for this sector lies in the policy push and India's high solar potential. The execution risks and grid congestion are currently the biggest worries though. This sector offers sustainably focused growth and is supported by both government commitments and international climate goals. Next is consumer durables, e-commerce and discretionary spending. The domestic growth engine that has kept India rolling while many major economies came to a halt. There are three key drivers here with demographic trends leading the charge. India's young population, with over 50% under 25 years, will drive consumption for decades. Income levels are also leading to higher spending on consumer durables, electronics, lifestyle products, and entertainment. Finally, e-commerce giants like Amazon, Flipkart, and regional players are expanding rapidly into Tier 2 and Tier 3 cities, enhancing retail penetration. This means consumer electronics, especially domestic brands, will benefit from urban consumption growth. Stocks like Amber Enterprises, Voltas, and Blue Star stand to gain here. Automobiles and two-wheeler stocks like Hero MotoCorp and M&M have also been reaping rewards. However, cautious investing is important here. Consumer spending is a fickle beast who can turn at the toss of a coin. FMCG leaders like Hindustan Unilever, Britannia, and Dabur, though, might have an easier time weathering any pent-up storms. They are lower beta, so that does limit upside potential as well. I would balance out the high and low beta consumption stocks to play that thin line of ideal risk and reward. When we talk about India, we cannot ignore pharmaceuticals and biotech. India is the pharmacy of the world, especially for generics and vaccines. My pick here would be Supriya Life Sciences for their niche in very specific products. They only make 25 products or so, but are completely backward integrated there, so that the supply chain issues cannot disrupt their business. That might be the primary reason that this stock performed well even though the geopolitical turmoil lasted for 4 years. Global healthcare expansion, especially in emerging markets, supports pharma export growth as well. India's market alone is expected to grow at 9% annually over the next few years. My pick here would be Mankind Pharma because 90% of its revenue is domestic, insulating the stock from any tariff or other forms of policy shocks. And growing investments in biotech and R&D and diagnostics hint at value-added opportunities. Acumen's Drugs would be my pick here for its promise in treatment for diabetes. Sun Pharma Advanced Research Company is also interesting for its valuation at the moment. The biggest advantage is India's cost advantage over competitors and established presence. The biggest threat is a dependence on China for APIs and regulatory crackdowns, especially under the Trump administration. Defense is another sector, but it is too important for just a part of this video, so watch this entire video dedicated to the defense sector in India.